What if I told you that the single most important financial event of the decade is happening right now, completely unnoticed by the vast majority of investors and financial news outlets? While everyone is obsessively focused on the Federal Reserve's official interest rate decisions, a far more powerful and transformative force is being activated in the shadows of the financial system, a silent, unannounced, and colossal wave of money printing that could single-handedly trigger the most explosive bull market in cryptocurrencies we have ever witnessed. This is a conspiracy theory. This is a cold, hard analysis of mechanics of modern government finance, and it's a story pioneered by one of the most prescient minds in crypto, Arthur Hayes. His thesis of quantitative easing is not just a prediction. It's a playbook for understanding how the U.S. government is trapped by its own debt and is being forced to choose between a catastrophic market collapse and secretly devaluing its own currency. The implications for your wealth are staggering, and by the end of this exploration, you will see the financial landscape through an entirely new lens, one that separates the noise from the truly seismic shifts. I need you to pay incredibly close attention to every single detail we're about to cover, because grasping this concept could be the difference between watching this wealth transfer from the sidelines and actively positioning your portfolio to capture life-changing gains. The entire story begins with a simple, inescapable, and profoundly ugly political truth. Democracies, especially one as deeply indebted as the United States, have an almost biological imperative to spend more money than they collect in taxes. It is a political death sentence to go to voters and tell them their Social Security benefits will be cut, their military funding will be reduced, or their infrastructure projects will be halted. Conversely, promising new spending is a surefire path to popularity and re-election. This creates a perpetual motion machine of deficit spending, where the bill for today's political promises is conveniently kicked down the road for a future generation to handle. The numbers are so astronomically large they become almost abstract, but we must confront them and understand the scale of the problem. The U.S. federal government is currently running a budget deficit of nearly $2 trillion per year, which represents a staggering 6 to 7% of the entire country's gross domestic product. Now, contrast that with the personal savings rate of the average American citizen, which has plummeted to a paltry 4%. Do you see the fundamental mathematical impossibility here? The private sector, the people and businesses within the United States, simply do not have enough excess savings to loan to the government to cover its extravagant spending habits. So, the U.S. Treasury Department has to go on a global borrowing spree, issuing trillions of dollars in new bonds, notes, and bills every single year just to keep the government's lights on. This is where the plot thickens and the first critical crack in the system appears. For decades, a reliable buyer of this endless stream of U.S. debt was foreign governments and their central banks, countries like China, Japan, and Saudi Arabia, who were happy to park their trade surpluses in the safe, liquid U.S. Treasury market. But the geopolitical landscape has shifted dramatically. The weaponization of the U.S. dollar through the freezing of Russia's central bank reserves sent a chilling signal to every nation on earth that is not a steadfast U.S. ally. It revealed in an instant that holding U.S. Treasury bonds is not a purely financial decision. It is a political one, and your assets can be turned into a tool of geopolitical coercion overnight. This has triggered a quiet but massive diversification away from the U.S. dollar, with central banks, particularly from the global south, buying gold at a record-breaking pace. So, if the American public can't buy all the debt, and foreign central banks are becoming increasingly reluctant to do so, we arrive at the multi-trillion-dollar question. Who is left to buy all these treasury bonds? The answer is not J.P. Morgan or Bank of America. The marginal buyer, the entity that has stepped into the void to become the primary engine of demand for U.S. government debt, is a specific and often misunderstood group of financial players, relative value hedge funds, frequently operating through legal entities in the Cayman Islands. These are not your typical stock-picking hedge funds. These are quantitative machines that engage in a complex but crucial arbitrage trade. Their strategy is to buy a treasury bond in the cash market and simultaneously sell an equivalent treasury futures contract, aiming to profit from the tiny, often microscopic, price discrepancy between the two. The profit on this spread is so infinitesimally small that to generate any meaningful return, these funds must employ astronomical levels of leverage, sometimes as high as 50 to 1. They borrow immense sums of money in the short-term lending markets, primarily the repurchase agreement or repo market, to finance their purchases. In this repo market, they pledge the Treasury bonds they just bought as collateral to secure an overnight loan, use that borrowed cash to pay for bonds, and then repeat the process the next day. This entire delicately balanced ecosystem relies on one single critical variable: the cost of that overnight loan, known as the Secured Overnight Financing Rate, or SOFR. As long as the SOFR remains low, stable, and predictable, the arbitrage is profitable, the hedge funds are happy to keep buying treasuries, and the U.S. government can continue its deficit spending without a hitch. But this is the fragile linchpin upon which the entire stability of the U.S. debt market currently rests. And it is precisely at this linchpin that the next and most dangerous phase of this crisis is beginning to unfold. So now we find ourselves at the precipice of the entire crisis, staring at the single point of failure for the entire U.S. Treasury market. We have a government with an insatiable appetite for debt, and we have a single dominant buyer, the levered relative value hedge fund, whose entire business model is built on the shaky foundation of cheap and endlessly available overnight loans. This is the calm before the storm, the quiet tension before the system breaks, and it is at this exact moment of maximum fragility that the Federal Reserve is being forced to reveal its true hand, activating what Arthur Hayes correctly identifies as the stealth quantitative easing program. To understand how this backdoor money printing works, you need to look past the headlines about the federal funds rate and peer into the Fed's more obscure plumbing. Specifically, its two key facilities for managing the boundaries of short-term interest rates. On one side, you have the reverse repo facility, which acts as a floor. This is where money market funds and banks can park their excess cash with the Fed overnight and earn a small return, effectively taking liquidity out of the system and setting a lower bound on short-term rates. On the other side, and this is the crucial piece of the puzzle, you have the Standing Repo Facility, or SRF. This is the emergency fire hose. The SRF is the Fed's promise to act as a lender of last resort to a specific group of eligible financial institutions, including primary dealers and potentially, in a crisis, a broader set of players. It allows these institutions to pledge their high-quality collateral, like the very U.S. Treasury bonds the government is desperately trying to sell, to the Fed in exchange for freshly created U.S. dollars, with the interest rate set at the Fed's upper policy bound. Let's be perfectly clear about what this transaction represents. It is the Federal Reserve digitally creating new money out of thin air and exchanging it for government securities. This is the essence of quantitative easing. Now, let's connect this technical mechanism to the ticking time bomb we just described. The traditional providers of cash in the repo market, the money market funds, and the big commercial banks, are finding their capacity to lend is being stretched to its limit. Why? Two powerful forces are converging simultaneously. First, the Fed's own quantitative tightening program is actively draining cash reserves from the banking system by allowing its holdings of Treasury bonds to mature without reinvestment. It is systematically removing the very liquidity the system needs to function. Second, with Treasury bill yields sitting at attractive multi-decade highs, these money market funds are finding it more profitable to simply buy T-bills directly and hold them to maturity, rather than engaging in the complex and potentially riskier business of providing daily repo loans to hedge funds. So, the supply of repo cash is shrinking at the very moment the demand for it is exploding due to the tsunami of new Treasury issuance. This is a classic and utterly predictable supply and demand shock waiting to happen. When the demand for overnight cash to finance Treasury purchases outstrips the available supply, the price of that cash, the SOFR rate, will inevitably spike. We have seen previews of this. Terrifying tremors in 2019 and again in 2022, where the repo market suddenly seized up and the SOFR rate shot violently higher. For the relative value hedge funds, a spike in SOFR is an immediate and catastrophic event. Their entire meticulously calculated arbitrage, built on leveraging a spread of a few basis points, instantly becomes unprofitable. Their trade blows up. When their trade blows up, they immediately stop being the marginal buyer of U.S. Treasuries. They go on strike. And when the marginal buyer U.S. debt goes on strike, the U.S. government faces an immediate and existential funding crisis. It cannot pay its bills. It cannot fund its deficits. The music stops, And the result will be a financial heart attack that would make the 2008 crisis look like a minor inconvenience. This is a ski cut that HAYES describes. The point of no return that the Fed, the Treasury, and every politician in Washington will move heaven and earth to avoid. And their only tool to avoid it is the standing repo facility. The moment SOFR threatens a break above the Fed's upper bound, the Fed will be forced, and I mean absolutely forced, to open the SRF fire hose wide. It will announce to the world that it stands ready to lend an unlimited amount of cash to any eligible borrower, accepting their Treasury bonds as collateral at a predictable cap rate. It will become the marginal lender of last resort to the repo market, effectively becoming the primary financier for the hedge funds that are the primary buyers of the government's debt. This is a stealth QE. It's not the grand, announced, bond-buying program of the past that everyone recognizes. It is a technical, backdoor, perpetual liquidity operation that achieves the exact same outcome. The Fed is printing new dollars to monetize the U.S. government's deficit. This new liquidity doesn't just sit idly in the system. It is a volatile, dynamic force. When the Fed lends to the SRF, it credits the borrower's bank account with new central bank reserves. These reserves are high-powered money that sloshes through the banking system, increasing its overall liquidity. This excess liquidity has to find a home. It seeks yield. It flows out of the safety of government bonds and into risk assets. It is a tidal wave of fiat currency being prepared offstage, and while its stated purpose is to maintain the stability of a U.S. Treasury market, its undeniable and colossal side effect is to inflate the value of every other asset on the planet, from speculative tech stocks to real estate, and most importantly, to the hardest, most resilient monetary technology ever created, Bitcoin. This is the silent signal that the smart money is already watching for, and it's a signal you must understand right now, because the moment the SRF is activated in earnest, the race for shelter from the coming devaluation will begin in earnest, and you need to be already positioned, not scrambling to catch up. Now that we have pulled back the curtain on the mechanics of stealth quantitative easing, the most critical and urgent question for you, as an investor and a saver, is this: where does all that newly created fiat liquidity actually go? And how can you position your portfolio not just to protect your wealth, but to see it grow exponentially during this period of monetary debasement? The answer lies in understanding the fundamental narrative shift that this backdoor money printing triggers, a shift that elevates Bitcoin from a speculative tech asset to a necessary, non-sovereign store of value in a world where the trust in traditional sovereign bonds is being systematically eroded. The first and most profound impact of stealth QE is psychological. It serves as a live-action demonstration, a real-time proof of concept, that the foundational promises of the fiat monetary system are broken. Remember, Bitcoin was born from the ashes of the 2008 financial crisis, created by the anonymous Satoshi Nakamoto precisely to be a cure for the disease of irresponsible central banking and bank bailouts. Its core innovation is an absolutely fixed, predictable, and unchangeable monetary policy. There will only ever be 21 million Bitcoin created, a fact enforced by immutable code and a decentralized network of nodes. Contrast this with the US dollar, whose supply is now being expanded through a technical facility to fund a government that is politically incapable of living within its means. Every single dollar printed via the standing repo facility to support the Treasury market devalues every dollar you already hold in your bank account, your savings, and your retirement fund. It is a silent tax on your purchasing power, a transfer of wealth from savers to the government. This act fundamentally validates Bitcoin's reason for existence. It's not just that Bitcoin might go up in price. It's that the dollar is being deliberately engineered to go down in value. And Bitcoin represents an escape hatch, a lifeboat from a sinking ship. This is not a niche, tech-libertarian view anymore. It is becoming a mainstream financial reality, and the influx of institutional capital is the hard evidence. The approval of spot Bitcoin ETFs in the United States was a watershed moment, a regulatory stamp of legitimacy that opened the floodgates for Wall Street capital. These ETFs, from giants like BlackRock and Fidelity, have already accumulated over $150 billion in assets under management, and they are rapidly closing in on the total holdings of the long-established gold ETFs, which stand at around $198 billion. This is a stunning pace of adoption, and it signals that large, sophisticated financial institutions are now using Bitcoin as a legitimate hedge against the very systemic risk we are describing. They are not buying it because they believe in the promise of decentralized peer-to-peer electronic cash. They're buying it because they understand monetary history and recognize that when reserve currency begins to falter, the world scrambles for a neutral, scarce, and globally recognized asset to store value. For centuries, that asset was gold. For the 21st century, it is increasingly becoming Bitcoin. But the institutional adoption through ETFs is just one channel. Recent regulatory changes have set the stage for an even larger wave of capital. A pivotal executive order has now cleared the way for cryptocurrencies to be included in 401k retirement plans. Let that sink in for a moment. This single policy shift has the potential to unlock trillions of dollars in retirement capital, the savings of millions of ordinary Americans, for allocation to Bitcoin. This isn't speculative retail money anymore. This is the bedrock of American long-term savings, and it represents a demand shock of historic proportions that the relatively small Bitcoin market has never before experienced. When you combine this tidal wave of potential demand with supply that is permanently fixed and a monetary policy that cannot be altered by any politician, you have a recipe for a price explosion that defies conventional analysis. Arthur Hayes' prediction of Bitcoin reaching $250,000 by the end of 2025 is not a random number plucked from the air. It is a direct mathematical function of the amount of fiat liquidity being forced into the system versus the fixed supply of Bitcoin. The global money supply, known as M2, for the world's largest central banks has already ballooned to a record $55.5 trillion. This is the ocean of liquidity in which all assets float. Stealth QE is the process of making that ocean deeper and deeper, and as the water level rises, the scarcest and most buoyant assets, the ones with the smallest fixed supply, will rise the fastest and the highest. Bitcoin is the scarcest asset humanity has ever known. It is more portable, divisible, and verifiable than gold, and its digital nature makes it the perfect store of value for a digital age. The stealth QE dynamic, therefore, creates a perfect storm. It simultaneously destroys confidence in the legacy system, forcing a search for alternatives, and it provides a literal trillions of dollars of fuel that will flow into that alternative. Your call to action at this very moment is to recognize that this is not a typical market cycle. This is a paradigm shift. The time for hesitant dipping of toes is over. The sophisticated money is already moving, positioning itself in the hardest assets before the real panic begins. Your portfolio allocation to Bitcoin should not be seen as a speculative gamble. In this new environment, it should be viewed as the most prudent and necessary form of capital preservation, the single most effective hedge against the covert devaluation of the currency in which you earn and save. The information is now in your hands, and the responsibility to act, to secure your financial sovereignty, is yours and yours alone. As we stand at the convergence of these colossal monetary and technological forces, it is vital to pull the lens back from the immediate price charts and recognize that what we are witnessing is not merely another market cycle, but fundamental and irreversible transfer of trust, a paradigm shift that will redefine the concept of money for generations to come. The era of stealth quantitative easing is the final, glaring symptom of a terminal disease within the old financial order, a system built on a fragile premise of trust in politicians and central bankers who have proven time and again that they will always choose a path of currency devaluation over fiscal responsibility. For the entirety of the modern financial era, the U.S. Treasury bond has been the undisputed risk-free asset, the bedrock of global finance, the safe haven in every storm. But what we have now uncovered is a devastating truth that this bedrock is cracking. The very process of creating and sustaining that risk-free asset now requires perpetual, opaque monetary intervention that systematically devalues the currency it's denominated in. This is a profound crisis of legitimacy. It signals that the trust which once underpinned the entire global financial architecture is rapidly eroding, and as that trust evaporates, it must flow somewhere else. It is flowing into a new, decentralized, and mathematically verifiable system of trust, a system not run by fallible humans in marble buildings, but by incorruptible code on a distributed network. This is the ultimate world historic significance of Bitcoin. It is not just an asset. It is a foundational layer for a new global economy. It is sovereign, non-political, borderless, and accessible to anyone with an internet connection. The desperate actions of the Fed and the Treasury, while designed to preserve their system, are ironically the most powerful marketing campaign this new system could ever ask for. Every activation of the standing repo facility is a commercial for Bitcoin's immutable monetary policy. Every $1 trillion added to the national deficit is a testament to the failure of a system that operates on promises and the superiority of a system that operates on proof. In this new world that is being born, your financial sovereignty is not a right granted to you by any government or financial institution. It is a responsibility you must claim for yourself using the tools now available. Bitcoin is the primary tool for claiming that sovereignty. It allows you to opt out of the cycle of devaluation, to store the product of your labor in a form that cannot be censored, cannot be seized easily by a third party, and cannot be inflated away at the stroke of a keyboard. The coming period of stealth QE will be marked by immense volatility and confusion in traditional markets. We will see wild swings, conflicting narratives from financial pundits, and desperate attempts by the legacy system to maintain its grip. But for those of us who understand the underlying dynamic, that the money printer is being forced back on, not off, this volatility is not a reason for fear, but a source of immense clarity and opportunity. The path forward is no longer a mystery. It requires you become educated, to take personal custody of your assets where possible, moving them off exchanges and into your own secure hardware wallets, and understand that the most important investment you can make is not just in a digital asset that might appreciate, but in a new, fairer, and more resilient system of money itself. The transition will not be smooth. The entrenched powers of the old world will not go quietly. They will fight this revolution with regulations, with fear-mongering in the media, and with every tool at their disposal. But the technological and economic genie is out of the bottle. The future of money is digital. It is decentralized, and it is provably scarce. The current monetary policies of the United States are not just setting the stage for a Bitcoin surge. They are proving, beyond a shadow of a doubt, why Bitcoin is not just an option, but a necessity for any thinking person who cares about preserving their wealth and their economic freedom. This is our moment to witness and actively participate in one of the most significant shifts in human history, the reclamation of monetary sovereignty by the individual. The information has been laid bare for you. The mechanism of stealth QE has been exposed. The connection to Bitcoin has been irrefutably made. The call to action is now clear and urgent. The financial system is screaming a signal at you, a signal of its own fragility and incredible opportunity that lies in its successor. It is now entirely up to you to decide what you will do with this knowledge. Will you be a passive observer, watching this revolution unfold on a screen, your purchasing power slowly eroding with every hidden operation of the Fed's lending facilities? Or will you be an active participant, taking a definitive step to secure your financial future by allocating to Bitcoin, by learning about self-custody, and by joining the vanguard of those building a better financial system? The choice is yours, and the time to choose is now, before the silent flow of liquidity becomes a tidal wave that revalues everything in its path. Do not let this moment be the one you look back on with regret. Take action, secure your sovereignty, and become a part of the future.